Let's turn our attention to the functions that financial managers perform. Financial management, or business finance, is concerned with managing an entity's money. In thinking about the activities that financial managers perform, let's think in terms of the balance sheet. On the left side of the balance sheet, we have assets. On the right-hand side of the balance sheet, we have liabilities and equities. Think about the left-hand side, the assets. Financial managers are involved in decisions as to how to allocate the firm's capital among the various assets. How much cash should we keep on hand? How much inventory should we keep on hand? Which pieces of equipment should we buy? So financial managers concern themselves with sort of the organization of the asset side of the balance sheet. Likewise, on the right-hand side of the balance sheet, we have liabilities and equities. Managers are concerned about finding the optimal mix of debt and equity. How much debt should the firm take on? If the firm is going to take on debt, what kind of debt should the firm take on? Should it take on bank loans? Should it take on bonds? These questions arise. What kind of debt? Likewise, the firm is concerned about how much equity, or the manager has to be concerned about how much equity the firm has. If there's not enough, the firm becomes very heavily levered and more risky. So there are incentives to not pay dividends. Having said that, the reason shareholders own companies is so that, at least in the long run, they'll receive dividends. So firms are concerned with developing sort of optimal dividend policies so that they're paying out enough in dividends to keep shareholders happy, but they're not paying out so much in dividends that they endanger the opportunities that the firm has to make more money in the future for shareholders. There's a nice figure in the text that describes the functions of financial managers in terms of the sort of daily or monthly, yearly activities that they engage in. On a daily basis, the financial managers are concerned with things like credit management. In other words, who are we going to give credit to? Which of our customers are we going to give credit to? Are there any customers we need to cut off from credit because we're in some danger that they may not pay us? It's important to give credit to those who are credit worthy and avoid giving credit to those who aren't. Likewise, inventory control. And by this we mean deciding how much inventory to have. If we have too much inventory, that's very costly. It costs money to stock the shelves. If we have too much inventory, we're incurring costs we would rather avoid. On the other hand, if we don't have enough inventory and we run out of inventory, we're going to miss some sales. So figuring out what that optimal inventory level is an important function of financial managers. Receipts and disbursements. That's this last item. Oops. Let's go back to it. This last item right here, receipts and disbursements. Those receipts and disbursements involve the company paying its bills. One of the reasons our suppliers might be willing to give us credit is we show that we're credit worthy. We pay our bills on time. If we don't pay our bills on time, we get worse terms in the future. The financial manager is responsible for making sure that the bills get paid on time. Now, on a more occasional basis, the center block here, the financial manager has to be concerned with things like stock issuances or bond issuances. Along with bond issuances might come borrowing money from the bank. These things don't occur on a day-to-day basis. In fact, the stock issuance might not occur for many, many years. However, when those things occur, the financial manager is front and center in those activities. He's also likely to bring in consultants in some cases on that when he reaches these points, because in many cases financial managers are really good at the daily activities. They're a little less confident sometimes in the activities that only occur every few years. The capital budgeting decision is likely to be somewhat ongoing, although not daily, and by that we mean deciding which pieces of equipment we should buy, if we have alternate decisions or alternate pieces of equipment that we could acquire that are mutually exclusive, which of the two should we get? These are questions that occur on a more frequent basis, but not daily. The dividend decision may be on a quarterly basis, although some firms just pay dividends on an annual basis. All of this is done within the framework of trading off maximum potential profitability for the firm against risk. Keep in mind that the goal of the firm as a whole, of all managers, in a sense, I'll circle it over here, the goal is to maximize shareholder wealth. These are the owners. We want to maximize the wealth of the firm's owners. And doing that requires trading off maximum profitability against high levels of risk. So let's consider what that means. When we talk about a trade-off, we mean we're not looking for necessarily the highest profit that's possible. If it requires taking on a great deal of risk, we might decide to forego the highest possible profit because it's not a sure thing. Likewise, financial managers aren't trying to avoid all risk. The way to avoid risk would be to just have the firm do nothing but buy government bonds. This would be a very low-risk activity, but shareholders wouldn't be very well served. That's not why they're hiring financial managers. They're hiring financial managers to assist in balancing the desire for profitability against their desire to avoid taking unnecessary risks. This trade-off that occurs between profit and risk influences the operational side of the firm. In other words, decisions about, well, should we buy a piece of equipment or should that would do the work of 10 employees, 10 men, or doing that's costing us money. If we had a recession, we can't lay off the piece of equipment, whereas we might be able to downsize our staff if we had individuals involved, or even if we're not concerned about laying off, we might be able to pay overtime to employees or cut their hours back in some way. And so having people versus capital is in many regards a lower risk activity. Capital meaning spending money on equipment. It may also involve decisions as to which product to make. Some products may have the potential for large payoffs, but there's high cost in producing them. If something goes wrong, we have big losses. So we're balancing the profit and risk objectives in our decision about what to do from an operational perspective. It also influences the financial mix. Having more equity, stock, reduces the risk of the firm relative to having more debt. If you borrow a lot of money, if the firm borrows a lot of money, that increases the risk. Having said that, the increased risk of borrowing money gives the owners, the shareholders, an opportunity to earn higher returns on the money they have invested in the company. So you can maximize your returns. The firm can maximize its returns by borrowing more, can maximize its shareholder returns by borrowing more, but it's also increasing the risks that the shareholders are facing when it does that.